Hello, and thank you for joining us for today's webinar, A Lump of Coal, CFRA's 2020 Holiday Outlook. Presenting today will be myself, Garrett Nelson, Camilla Yanuszewski, and Tuna Amobi. All of us are senior equity analysts with CFRA who follow various segments of the consumer space. Here on slide 3 is our agenda today. After a brief introduction, I'll provide an update on some of the recent macro developments affecting consumer spending and consumer fundamentals. Then, Camilla will provide CFRA's 2020 holiday retail outlook before handing it off to Tuna, who will discuss Amazon's evolving ecosystem. Finally, I'll finish up with a look at big box retail, and then hopefully we'll have some time for Q&A at the end. CFRA blends fundamental equity research with forensic accounting techniques. Our research covers all 11 sectors and 68 industries. On a qualitative basis, we cover more than 1,500 companies globally, and on a quantitative basis, over 25,000 companies. I would also highlight that CFRA's acquisition of First Bridge Data last year greatly expanded our offerings in the ETF and mutual fund category. This next slide shows the outperformance of some of our model portfolios over time, and we think demonstrates CFRA's strong track record of stock picking over the last decade or two. One important distinguishing factor about CFRA is our independence. Research is all we do. CFRA does not manage money or make trades and does not have an asset management arm. And so without further ado, let's move ahead to our consumer update. One thing that's so important to understand about the US economy that makes it different from a lot of other major economies around the world is that it's so consumption driven. So the pie chart on the left here shows the breakdown of US real GDP last year between the 4 components of GDP, which equals consumption plus investment plus government spending plus net exports. US real GDP was about $19 trillion last year, and the consumption part of that equation is the largest. It accounts for close to 70% of total US GDP as shown here. We feel that the US economy is really at a critical crossroads at this point in time, with stimulus having waned and consumers having pulled back on spending over the last few months. And we believe the rebound in US GDP will largely depend on consumer confidence and the overall health of the consumer. And because the US economy is by far the largest in the world, and it's still about 50% larger than China's, which is the second largest, the US consumer to a large extent really holds the key to a broader global economic recovery. And the pie chart on the right here shows the breakdown of that $13.3 trillion of personal consumption. And the breakdown was about 64% services, 23% non-durable goods, and 13% durable goods in 2019. So this is why you often hear economists talk about the US economy as being very service-driven, because industries such as banking, large portions of technology, healthcare, the legal industry, all those industries fall under that umbrella of services. Looking at the next slide, some of the key indicators of US consumer health. After the single greatest quarterly decline ever in GDP in Q2, US GDP then posted the strongest growth ever in Q3. And if you look at the Atlanta Fed's GDP Now forecast for the 4th quarter, they're currently estimating 5.4% growth for Q4. So a much more normal but above average growth rate. And if you look at the unemployment rate, while weekly jobless claims are still stubbornly high, being between 700,000 and 800,000 each of the last 4 weeks, the US unemployment rate has fallen for 6 consecutive months now, from a peak of 14.7% in April to just under 7% in October. The next slide shows monthly retail sales and the household savings rate. The retail sales chart, not surprisingly, looks very similar to the US GDP chart from the last slide, which is not a surprise because, as we just learned, the US is such a consumption-driven economy. You had a point back in March and April where spending on discretionary items really just dropped off a cliff. But then you had the stimulus checks go out and also the supplemental unemployment checks, which the combination of those things put a lot more cash in consumers' pockets. And that's right as COVID cases really dropped off and large portions of the economy reopened. So we had this huge snapback in retail sales, which has since normalized to more normal rates. Yesterday, the October retail sales came out. It showed 0.3% growth in October, which was actually the weakest sales monthly sales total since April. On the right here, one silver lining we've seen over the last several months is that the financial health of U.S. households has improved in terms of the savings rate. Savings rates have really gone up, and that for years economists have pointed to as an area of concern when looking at the overall health of the U.S. consumer. Next, looking at consumer confidence. While confidence has bounced back comfortably above the trough from back in April, the November reading of 77 was well below the pre-pandemic high from back in February, which was 101. And then on the right, the economic optimism index right now stands right at 50, which is the exact level separating optimism from pessimism. So you can see with all of these indicators that the economy is really at a critical point in time in terms of consumer sentiment, and where things go from here will largely depend on developments related to the vaccines and the virus, and what additional stimulus measures are taken, if any. Here on slide 12 are outlooks for the two consumer sectors, consumer discretionary and consumer staples. A recommended weighting right now is overweight on consumer discretionary and underweight on consumer staples. Obviously, consumer discretionary names tend to be higher growth. They're more cyclical, but they also have lower dividend yields. They tend to be higher beta names and have higher leverage ratios. And consumer discretionary is the group that's really had an enormous rebound ever since the stock market bottomed in late March. Conversely, consumer staples names tend to be larger companies on average. They tend to be more defensive, more value oriented. They pay more generous dividends. They tend to have lower betas and have lower leverage ratios on average. And consumer staples is a group that really outperformed during the early days of the pandemic back in early March. But since then, the discretionary names have really had all the momentum, with the S&P 500 having posted the largest rally in the shortest period of time in history from the bottom, which was back on March 23rd. So we've certainly seen a V-shaped recovery so far as the stock market is concerned. And so with that, I'm going to hand off to Camilla. Thank you.
Good morning. My name is Camilla, and I'll be taking you on a deeper look into CFRA's holiday retailing outlook. As you can see on the chart on the right, the holidays are a critical time for the retailing industry. Players such as Amazon and Walmart, to Target and Macy's, generate nearly a third of their annual revenues during this festive time. On the next slide, you can see our base case. Our base case is that holiday retail sales, which we define as the months of November and December, will be flat year over year, coming in at $1.05 trillion. This could mark the first year of flat growth since 2008. For comparison, in 2019, retail sales were up 4.4%. Our muted outlook rests on the health of the U.S. consumer. As Garrett mentioned, consumer confidence continues to be far below pre-pandemic levels. And while we have seen continuing claims recently make a new pandemic low, it's important to underscore that these figures don't reflect the workers that exited the labor force or exhausted state aid and simply shifted to a different program for the longer-term unemployed. On the next slide, you can see another key indicator that we look at: time spent away from home. We've seen this indicator start to subside. And our bear case is that as infections continue to set new daily highs, the COVID-19 Grinch will prompt widespread store reclosures and in turn, steal some holiday cheer. On the flip side, our bull case is that fiscal stimulus will be passed before year end. And this feeds well into the next slide, which is, what is the shape of the economic recovery going forward? We see a K-shaped economic recovery, which means a restoration of various sectors at different paces. And how this relates to our holiday outlook is we see higher income Americans, which have seen quicker growth in their income and faster restoration of jobs, they are well positioned to splurge, specifically with money that they would have otherwise spent on pandemic-reliant services such as travel and entertainment. On the flip side, lower and middle-class Americans, they may embrace frugality and reserve their spending for essential items as fiscal stimulus starts to run low. This group has seen tepid income growth and a slower restoration of jobs through this pandemic. Next slide. Consumer wish lists. What do consumers want this holiday season? A survey conducted by the National Retail Federation found that 54% of consumers want gift cards and 47% want clothing and accessories. These were also the most popular categories last year. In terms of investment strategy, we did see better than expected news from Pfizer last week, and given the lockdown liberating implications of the news, we do see investors favoring more cyclical sectors in the coming months. So for example, sub-industries like apparel and accessories and luxury goods, which have underperformed the market year to date for various reasons like tepid demand among social distancing guidelines, and then also inventory challenges from lockdowns, we think this group specifically is well positioned to outperform in the coming months. Also on this slide, in terms of wish lists, we are seeing more demand for home decor and home furnishings. And that's driven by COVID-19 cocooning. We've seen consumers take on more at-home living projects. Next slide. Looking at channels, consumers plan to make more holiday purchases online this year. We're expecting e-commerce will account for 16% of fourth quarter sales. That's compared to 11% in the fourth quarter of 2019. The reasoning behind that, we think, is that if you look at consumer psychology before COVID-19, there was definitely a group of consumers that simply did not trust online shopping. And that's because the physical store provided consumers with a sense of reliability, a sense of comfort. They knew that if they were to go into that store, that dress would be the perfect fit. They knew if they were to purchase that sofa, it would have that right level of cushioning that they were looking for. But now e-commerce, amid COVID-19, is providing consumers a sense of comfort that they've simply never indulged before. You can see on this slide a survey from the National Retail Federation, which found that 60% of consumers plan to make holiday purchases online this year. Next slide. That's not to say, however, that the physical store will become obsolete. What we see as the new normal in brick and mortar retailing is that omni-channel values will be embraced front and center. We really see the store taking two variants. Variant one is a merchandising display in the front of the store in a warehouse backroom. Variant two is smaller store formats with essentially localized fulfillment center. You can see on this slide that retailers expect to fulfill more orders using buy online, pick up in store. There are several benefits that come for retailers for buy online, pick up in store. We think as a whole, it allows retailers to better compete with Amazon. But other benefits include cutting down on shipping costs, also a bolstered store foot traffic, and it also offsets some fixed store lease expenses. Next slide. COVID-19 is also challenging the traditional holiday calendar, causing big days like Black Friday and Cyber Monday to lose their relevance. You can see on this slide that 74% of consumers expect a longer holiday shopping season this year. This stems not only from the pandemic and people's desire to avoid crowds, but also to avoid shipping delays, and also in part spearheaded by Amazon's Prime Day. Amazon's Prime Day was historically held in July and marked the start of the back to school, back to college shopping season. This year, it was held in October, and some would say it marked the unofficial start of the holiday shopping season. Next slide. This slide looks at store opening plans and consumer spending plans for Black Friday and Thanksgiving. On the left, a survey of retailers found that only 25% expect to definitely have their stores open on Thanksgiving, and 78% definitely on Black Friday. On the flip side, looking at consumers, only 12% of consumers are very likely to shop in stores on Thanksgiving, and only 11% are very likely on Black Friday. Next slide. So that brings me to the big question. Which retailers make the naughty or nice list this year? On this slide, you can see our forecasted winners and losers. And I'll dive into the methodology in the coming slides. But in terms of winners, apparel and footwear manufacturers, which I did start earlier, names in the space include Canada Goose, Columbia Sportswear, Deckers Outdoor, VF Corp, and then also home goods, specifically digital first retailer Williams-Sonoma. And then we're bearish on the department store industry as a whole, specifically Dillard's, Kohl's, JCPenney, Macy's, and Nordstrom. Next slide. In order to forecast our holiday shopping winners and losers, every year we run a digital traffic analysis of Alexa Intranet's data. Our approach takes into consideration the changes in Alexa Intranet's global rank, or so-called, it's essentially a site popularity metric, over the past 3 months as of November 1st versus the prior 3-month period. And the assumption with that analysis is that the momentum of brands entering holiday will stay the same course directionally. The reason why we look at website traffic is because we believe that in-store traffic and digital traffic are directly and positively correlated. The International Council of Shopping Centers conducted a study which found that opening one new physical store in a market resulted in an average 37% increase in overall traffic to that retailer's website. Obviously, that's compared with web traffic prior to the store's opening. Similarly, the organization found that web traffic declines when retailers shrink their footprint. In one retailer's case, they noted that the share of web traffic across the markets where the retailer closed stores was down as much as 77%. The International Council of Shopping Centers also did a follow-up study, which found that when a shopper spends $100 on an online site and then goes to that retailer's physical store within 15 days of the digital purchase, the consumer on average spends an additional $131. That's for an aggregate sum of $231. This halo effect is even more apparent when the purchase begins in the physical store and then goes to the digital site, with the 15-day aggregate sum coming in at $267. Next slide. Looking at department stores, you can see the steep traffic declines the industry has posted ahead of the holiday season. And for declines, you're going to be seeing red numbers. And I'm going to walk you through other metrics on this slide to give you a deeper understanding of what metrics we look at and what the changes signify. Global rank, which I mentioned earlier, it's an estimate of a site's popularity relative to all other sites over the past 3 months. And we present a change versus prior. We also look at a metric called global reach, which is the percentage of daily global internet users who visited the site over the past 3 months. And we also do a change versus prior 3-month period. There's a metric on the slide, country rank. We look at the US, and it's an estimate of a site's popularity among users within that country. So for example, if you have a site like Amazon or Google, those are going to rank towards the top. They're extremely popular. Consumers are on them, users are on them every day. And then also global page views, which is more self-explanatory. It's an estimated percentage of daily global page views on the site over the past 3 months. Digging more into department stores, the drops don't really come to us as a surprise. We've had a negative outlook on the sub-industry even before COVID-19. And we've been saying that this industry has been in a death spiral, really driven by one, a hefty debt load, which has threatened innovation for this industry. And second, the proliferation of e-commerce, which has completely destroyed the historic appeal of department stores for one-stop shopping. On the next slide, we look at specialty retail, but we take out apparel retail to look at in the coming slides. Digging deeper into this slide, the trends that we saw were accessories and home furnishings. Their digital sites were increasing in popularity ahead of the holiday season. And that ties into the survey that we highlighted earlier, with clothing and accessories topping lists again, with elevated demand for home decor and home improvement. Zales, Jared, those are jewelry players. Williams-Sonoma, digital first, home furnisher. Tiffany's jewelry. Next slide. Bed Bath & Beyond, you're gonna get some of your home decor there. Kay, you're gonna get some jewelry. And then the rest of the players on the slide is a mixed bag. Companies like GameStop, Dick's Sporting Goods, Tractor Supply, Five Below, they all have very different business models, which is why they're thrown into specialty retail. Next slide. Apparel retail. The big trend that we saw among this group is that the mall-based apparel retailers saw decreasing popularity ahead of the holiday season. Very similar reasons, we have a negative outlook on mall-based apparel retailers. Very similar reasoning to department stores. where they are burdened with hefty debt loads. And also the proliferation of e-commerce has destroyed the appeal of the mall for one-stop shopping. That's why you see companies like Gap, Foot Locker, Victoria's Secret, Urban Outfitters, big drops ahead of the holiday shopping season. Next slide. And you can see American Eagle, Guess as well. In terms of the names that we put on these slides, these are retailers that are qualitatively rated by CFRA. We looked at every single one of them. Next slide. And the last industry that is worthwhile to highlight is apparel, accessories, and luxury goods. The big trend that we noticed among this group is that winter brands' digital sites are increasing in popularity ahead of the holiday season. Brands like Canada Goose, UGG, Columbia. On the next slide, you'll also see the North Face. And we think part of the reasoning for their increasing popularity ahead of the holiday season is expectations for a colder than normal December. That's a typical response to La Nina, which is a scientific term, but essentially it's the cooling of the sea surface temperatures in the Pacific Ocean. And now I'm going to pass it on to my colleague Tuna, who is going to speak more on Amazon.
Yes, thank you so much, Camilla, and good morning, everyone. We are thrilled today that you're able to join us. And I'm going to be, in the next few minutes, looking at Amazon's evolving ecosystem. Before I delve into the first slide, I think it's fair to say that Amazon's influence on the retail landscape, as you guys know, can be aptly described in the sense that if Amazon sneezes, I think it's fair to say the whole retail landscape would catch a cold. So hence our decision to kind of delve deeper into the ecosystem of this dominant provider. So on this slide that you are looking at here, I thought it's interesting to kind of look at some of the key factors that are influencing online shopping with the onset of the COVID-19 lockdown. And this is based on a third-party survey. So notice that all of these key factors, the top three in particular, product quality, speed of delivery, and price, these are all factors that Amazon very much excels in. And you can go down that list, whether it's kind of trustworthiness, authenticity, refund, and so on. The takeaway here is that the COVID-19 lockdown, these factors have become even more important. We think that Amazon is very, very well positioned to continue to dominate and thrive in this kind of new dispensation. Moving on to the next slide, we're kind of looking at the secular and holiday e-commerce trends. I think one thing is pretty clear as we've kind of come off 2 quarters of COVID-19 impact on the retail landscape. Our takeaway is that COVID-19 has significantly accelerated the secular tailwinds for U.S. e-commerce growth. The e-commerce market has been on a secular growth trajectory for several years. And along comes COVID-19, and what it's done is to kind of highlight some of those trends even more. On the chart on the left is the U.S. retail e-commerce sales. Notice the spike that has occurred in this year, and whether it's on the year-over-year growth or the percent of total retail sales. That trend line has been going up for the last several years. The year-over-year growth that we see this year has spiked quite remarkably. On the chart on the right, which is just for holiday e-commerce sales, the same story is quite evident. You see this spike in the holiday e-commerce sales, thanks in large part to the COVID-19 lockdown, stay-at-home online shopping that we have witnessed for the past few quarters. The next slide, please. So moving on to this slide, we'll look at Amazon's share of US e-commerce sales. So as you can see here, over the last several quarters, in absolute number and also in percentage terms, Amazon's share of US e-commerce sales has been pretty much on the rise over the last 3 years or so, adding about 140 basis points of share. Now, when you think about it, I think it's really astonishing that one company is on the cusp of garnering about 1/4 of total US e-commerce sales, happening at a time when e-commerce competition has accelerated. All of the retailers have been investing heavily in omni-channel, and from Amazon to maintain this dominant share is quite remarkable, and which has been on the verge of accelerating, due to the e-commerce, due to the COVID-19 lockdown. So that's kind of one trend that we kind of keep an eye on. And moving on to the next slide, we look at Amazon's e-commerce trends in physical stores. A takeaway here being that e-commerce and physical sales have further diverged during the COVID-19 lockdown. On the chart on the left, Amazon's e-commerce revenue by business lines. You can see the components there: online sales, third-party seller services, and subscription services, primarily Prime membership subscriptions. You see that all of those key components have been on a pretty strong growth trajectory. No surprise there. All the way through the third quarter, just kind of reported. That is a trend line that we continue to expect to be sustained. And on the right side, you'll see the comparison of Amazon's online sales versus its physical stores. And those physical stores are primarily comprised of Whole Food stores, but also including a number of the Go convenience stores, those contactless stores that Amazon has been gradually rolling out. The bookstores are in there as well, the pop-up sites, the mall kiosks. So the chart pretty much shows an interesting divergence between the online and the physical. The latter are actually turning negative in the last 2 quarters as more and more consumers stayed home while doing more of their shopping online. So that is a trend, by the way, that as you heard, Camilla, has been quite apparent pretty much across the retail landscape through the COVID-19 lockdown, with more and more shoppers taking advantage of online capabilities and staying away from the physical stores for the reasons of the COVID-19. Moving on to the next slide here, we look at Prime membership growth. Clearly, it wouldn't be complete to talk about Amazon's ecosystem without delving into its Prime membership growth, which have been a major catalyst for Amazon's e-commerce growth. So on the left side of that chart, you'll see the Prime members. We estimate that we're looking at north of 140 million Prime users by the end of this year, and you'll see that the component of digital buyers that are engaged on Amazon Prime membership is actually now approaching almost 3/4 of digital buyers are now engaged. So that's quite remarkable as you see the trajectory for continued strong growth in Prime membership. These Prime members are pretty attractive, very good economics. They spend higher. The order values are higher than non-Prime members. So to the extent the company can sustain this growth, it's a very high margin component of their business. The right side of that chart shows you the Prime Day sales. Amazon just coming off last month of its 6th annual successive Prime Day. And you'll see that this Prime Day initiative was launched in 2015. And over that period, Prime Day sales, which by the way is a global phenomenon, both in the US and international markets, has more than increased tenfold through the last Prime Day that we just saw. The popularity has been off the charts. and you'll see the number of hours of this promotional event has evolved from one-day event to most recently a two-day event, just based on the type of popularity that the event has generated. So look for that to be a continued crucial element of the Amazon thesis and the continued growth in the e-commerce platform. The next slide, want to talk about the benefits mostly used by Prime members, right? So no surprise here that free shipping is the most popular benefit for Amazon Prime subscribers. This is based on a survey by S&P Global Market Intelligence. So look at the number of respondents that kind of on free shipping. That is far and away higher than a lot of other perks available to Prime members. Amazon Prime Video comes in second, and you see a host of other perks as well, which are found most attractive. So that to us explains why shipping will continue to remain a major battlefront for a lot of these online competitors. You see a lot of competitors investing heavily in shipping and logistics, and we'll touch on that for Amazon pretty soon in a little more detail. Moving on to the next slide, third-party sellers on Amazon's e-commerce platform. For those of you who don't know what third-party sellers are, these are independent merchants on Amazon, where pretty much Amazon would be responsible for fulfilling their merchandise based on orders on the platform. These are extremely high margin business for Amazon, where they charge them fees, fulfillment fees, service fees, etc. And much of that drop into the bottom line. The left chart shows the percent of paid units on Amazon platform by third-party sellers. Notice that that trajectory has been upward bound for the last several quarters. I think it reached a tipping point about 3 years ago of more than half of the paid units sold by third-party sellers on the entire platform. And what we've seen in the last couple of quarters is a continued acceleration in that metric. No surprise that third-party sellers have grown with the practical challenges that the COVID-19 lockdown has faced. So again, we think the COVID-19 has been an accelerant to continued growth in the percent of paid units on by third-party sellers on Amazon platform. On the right side, I see the third-party retail revenues, again, accelerating in the most recent quarters, thanks in large part to the COVID-19. So kind of look at this COVID-19 as somewhat fortuitous for Amazon, where the secular trajectory had been, on the upswing and now accelerating as we kind of look at, the recent trends. Moving on to the next slide. Here's where we talk about logistics, and this is an extremely important, trend when you think about how Amazon's shipping and fulfillment investments have evolved over the last several years. The most recent impetus here has been the launch of the one-day delivery for Prime members in the Q1 of 2019. And they went through last holiday season, Amazon, on this. There was concerns whether they were going to be able to meet the surge in demand and how this one-day delivery could hold up. And I would say that they kind of came out of that in flying colors. This coming holiday season is going to be another litmus test for how this one-day delivery is going to hold up. So far it seems like the surge that we have seen with the COVID-19 demand tailwinds will provide another kind of rationale for the return on investment in this one-day delivery coming from two-day delivery. And we estimate that Amazon has spent billions of dollars, perhaps $12 to $15 billion since on just this one-day delivery transition from two-day delivery. And I would expect this to be one of the more compelling perks for Prime members as we kind of look out for this holiday season. No surprise also that a lot of Amazon's competitors have now tried to up their game in the delivery space, where they realize that more and more consumers value this as a very, very crucial element. Moving on to the next slide. I figure that, while this, presentation is all about Amazon's e-commerce, but I wanted to draw the attention as well to the role that Amazon's cloud segment really plays when you kind of think about, what's going on in their e-commerce platform, the heavy investments that they are making. Let's not forget that cloud segment is still the golden goose, if you will. So year to date, while the cloud segment accounts for only about 13% of the total consolidated sales, they're now accounting for about 62% of the total consolidated operating income. And in fact, in some of the more recent earlier periods, that percent of operating income has been well north of 75 to 80%. And this is all happening while the company is investing a lot of the profits from the cloud segment back into the e-commerce, including most recently billions of dollars in additional COVID-19 costs. In the last 2 quarters, we think Amazon has invested north of $8 to $9 billion in COVID-19 costs that were not even anticipated coming to these earnings, things like masks and sanitizers and all kinds of testing for employees, et cetera. And all of those numbers are built into these costs. The footnote for both the sales and the operating income by segment, you'll see on both charts, the footnote, the Q4 guidance, which is pretty, I would say quite conservative, because the company tends to guide and then come in really towards the higher end of that guidance. So we expect that this will also happen this holiday season, where we expect that the COVID-19 tailwinds will enable the company to continue to maintain that momentum. And also after all of these investments in delivery, as well as the COVID-19 costs, all of that baked into these numbers. And moving on to this chart would be my final chart. This is an intriguing chart here to me. When you look at the, and by the way, this is based on third-party retail index. It's pretty remarkable what COVID-19 has done in terms of reshuffling of the overall retail landscape. One thing here is consistent with our expectation that online shopping figures to be one of the clear winners, if not the clear winner of the COVID-19 lockdown. And if you look at the other categories, I think department stores, which dovetails into the bearish stance that Camilla had talked about. The main question here is, what happens from here on out? And what happens is that it's pretty clear that this is not going to be business as usual. COVID-19 has really, changed a lot of the traditional retail paradigm. And I think that's really going to be crucial as we kind of think about our outlook for 2021. But suffice to say that, for this year, there's a lot of reshuffling going on in the retail landscape as a result of COVID-19. The key is going to be how much of those reshuffling is going to be sustainable and what impact that does have, going forward. So with that, I'm going to turn it over to Garrett to talk about the big box retail segment of the presentation. Garrett?
Great, thanks, Tuna. One thing I just want to point out very quickly is that you can submit questions at any time using the chat feature. We've had some questions come in, but I think we'll probably have time for some additional questions after I finish this final segment. This final segment before the Q&A is on big box retail, which includes names such as Walmart, Costco, and Target. And here's a timeline of some of the factors which have driven an acceleration of revenue and earnings for the big box retailers in 2020. If we rewind back to March, that's when the pandemic really hit, and immediately there was a surge of pantry stockpiling. We saw the toilet paper shortages, hand sanitizer, canned goods, and so forth. And then came a period where they really started to pick up market share as consumers made fewer trips to the store, but also purchased much larger than normal basket sizes on each trip. And they really took share from a lot of non-essential businesses, particularly small businesses and mall-based retailers. Then the stimulus and unemployment, supplemental unemployment checks get sent out. That put a lot more cash in consumers' pockets, and they went out and spent a lot of that additional cash. And as we'll see, the big box retailers really capitalized on the surge in e-commerce sales because they started investing very heavily in e-commerce and supply chain years earlier. And one thing we're seeing more recently, just in the last 2 or 3 weeks, with the resurgence of COVID cases, one thing Walmart talked about on their earnings call yesterday is that we're seeing a return to some of the trends we saw back in the spring with fewer trips to the store, larger basket sizes, and a further acceleration in e-commerce sales. If we look at the next slide, this shows the revenue mix for Costco, Walmart, and Target. And the key takeaway is that Costco and Walmart have a very similar revenue mix. Grocery equals about 56% of total revenue. For Costco, that's taking the food and sundries plus the fresh food percentages. So 56% of total revenue for both Walmart and Costco. While Target is much more of a discretionary and general merchandise play. For Target, grocery only accounts for about 20% of net sales. Slide 47 shows e-commerce CapEx for both Target and Walmart over the last several years. And I didn't include Costco here because they don't specifically break out their e-commerce CapEx. But what these charts show is that Target and Walmart have been investing very heavily in developing their supply chains in e-commerce capabilities for several years now. The lines on each chart shows what percentage of each company's total capital expenditures e-commerce accounted for. And interestingly, Target's e-commerce CapEx actually peaked way back in fiscal 2014 at 60% of its total CapEx that year, while Walmart has increased their e-commerce CapEx every single year since 2014. And that's one of the reasons why we like Walmart so much at the moment. We have a strong buy rating on the stock because we think this very high level investment sets the stage for much stronger revenue and earnings growth going forward, particularly following the launch of Walmart Plus in mid-September, which I'll talk more about in a minute. This next slide shows both the e-commerce sales growth and the same-store sales growth of the big box retailers over the last several quarters. E-commerce sales growth is shown in the chart on the left, and same-store sales growth in the chart on the right. And I want to point out that e-commerce sales growth is included in same-store sales growth. So the growth shown in the chart on the right has largely been driven by the higher growth rate shown in the chart on the left. Just if anyone didn't know, that's how retailers calculate their same-store sales growth. And you can see that e-commerce sales really took off starting in Q1 of this year, and that growth accelerated in Q2, which was the first full quarter of the COVID effect, if you will. Target's e-commerce sales growth was up almost 200% in Q2, while Walmart and Costco's e-commerce sales growth was up by almost 100% year over year. And I've updated these slides for both Walmart's third quarter earnings release yesterday and Target's earnings release this morning. And you can see that while growth was still very strong for both companies in the third quarter, it actually moderated a bit from Q3 levels. Costco will report their earnings next month. This next slide shows North America's top retailers of food and consumables. And Walmart is the largest grocer by a wide margin. Grocery accounted for about 56% of their net sales last year, as we saw on the other slide, for their Walmart US segment, which is their largest segment. Grocery sales totaled about $190 billion for Walmart. And if you add their Sam's Club segment, for which grocery sales totaled $35 billion, those two segments brought Walmart's grocery sales to over $225 billion. And that doesn't even count Walmart Canada or Mexico and Central America, which also make the list of the top 25 food and consumable retailers in North America here. So that really gives a sense of how dominant Walmart is in the grocery industry. It's really their bread and butter, no pun intended. And Walmart's e-commerce sales have grown dramatically in recent years, which really has been mostly driven by curbside pickup. But we think that will really shift significantly going forward with Walmart Plus home delivery, which we think is going to really revolutionize the way that millions of people buy their groceries in the US. Slide 50 shows US grocery sales, which totaled about $1.02 trillion last year, as well as what percentage of those sales are e-commerce. And what this shows is that grocery e-commerce really accelerated this year due to COVID and is expected to grow the market share by 200%, from a 3.4% share in 2019 to a 10.2% share in 2020. And that share is expected to grow to 21.5% in 2025. And you can see how these forecasts change from before COVID, which is the blue line, and the new estimates, which account for COVID, post-COVID, shown by the orange line. And this COVID-related grocery e-commerce boom, we think will stick because people love the convenience of both curbside pickup and home delivery. And in fact, surveys show that 90% of online grocery shoppers said they plan to continue buying their groceries online post-pandemic. On to the next slide. We think Walmart Plus could be a US grocery game changer because of their grocery dominance and also the fact that it really plays to Walmart's competitive strengths. An amazing statistic is that over 90% of the US population lives within 10 miles of a Walmart store. And that's so important when we're talking about grocery e-commerce because refrigeration capacity is essential when you're talking about milk, ice cream, produce, and other perishables. And that's just something Amazon just doesn't have at the moment. They do have their massive distribution centers, and they have roughly 500 Whole Foods stores that they own, but that's less than a tenth of the number of Walmart plus Sam's Club stores in the US. And also those Whole Foods stores, the average number of items, SKUs as we call them, is much smaller than Walmart on average. So here is the list, the initial list of member benefits for Walmart Plus, which Walmart says will grow over time. And moving on to the next slide, early indications show that the new service has been well received by consumers since the September 15th launch. In fact, less than 2 weeks after Walmart Plus launched, a consumer survey firm called PeopleSay conducted a survey of over 20,000 Americans about Walmart Plus, and here's what it showed, which was really staggering from my perspective. It showed that 11% of those surveyed said they had already subscribed, and another 27% said they had heard of the service and were considering subscribing. So those results implied that about 14 million households subscribed to Walmart Plus in the first 2 weeks, and another 36 million were considering subscribing, which adds up to about 50 million households total. So compare that to the number of Amazon Prime members, as Tuna mentioned, which totaled 124 million at the end of last year. So we think the survey showed that on the right, it showed that the unlimited free delivery feature was the most popular with consumers. And so if Walmart wins, who loses? And the answer, in our view, is pretty much all of its competitors. Membership clubs such as Costco and BJ's, because those are also subscription businesses, and consumers might decide they just don't need Walmart Plus and a Costco membership or BJ's membership, particularly given the fact that Walmart Plus also offers fuel discounts, which are very popular features at membership clubs. And also Walmart's plan to leverage Sam's Club for home delivery of the large bulk products that are so popular at membership clubs. Next, we think all other grocers lose, particularly the smaller ones with little or no omnichannel capabilities, as the value proposition of Walmart's everyday low prices plus home delivery is very difficult to compete with. In fact, we think it could be devastating for a lot of grocers if a lot of consumers migrate away from them toward Walmart Plus, because grocery margins are already notoriously razor thin. Then finally, we think general merchandisers will also lose market share as consumers take advantage of the free same-day delivery on non-grocery items as well, which is exactly what Walmart Plus wants to happen, I would add, because non-grocery products generally have much higher margins. So that's a threat to small businesses, to department stores, mall-based retailers, as well as general merchandisers such as Target and Amazon. Finally, we think big box retailers, these are our concluding thoughts, we think big box retailers will post above average same-store sales growth this holiday season. So we think across the board, their same-store sales will be up year over year relative to the no growth forecast we have for US retail as a whole. And that will really be driven by their e-commerce businesses. We also think rising COVID cases could benefit big box retailers due to fewer planned store visits and strong e-commerce sales, which is a trend that Walmart confirmed that they're seeing in recent weeks on yesterday's conference call. And then finally, none of this is to downplay the threat that Amazon presents to big box retail and grocery e-commerce if they choose to expand their grocery delivery and their focus to more of a nationwide footprint instead of being more of a suburban provider right now with Amazon Prime. The important thing to understand, as Tuna covered, is that Amazon has something that the big box retailers don't, which is AWS, their cloud computing business, which generated a 26% operating margin last year, and that just dwarfs the margins of their retail e-commerce segments, dwarfs the operating margin that Walmart generates and the rest of big box retail. And AWS is also growing very strongly. So Amazon could essentially use that business to subsidize their e-commerce business if they wanted to, and they really wanted to get bigger in grocery. And so with that, we'll open it up for Q&A. I see that we've received a number of questions. I think we're going to save about 5 minutes here for Q&A. Just give me a few seconds, please, to compile the list of questions. Okay, quick question. This is for me. Does CFRA have a buy or strong buy rating on Walmart? I didn't see the rating mentioned. Our rating is strong buy right now. We raised our price target by $10 to $170 yesterday. Next question is for Camilla. Camilla, among the department stores, who is better positioned?
Sure. From a real estate perspective, definitely Kohl's. Around 95% of their portfolio is freestanding or in strip centers. And we think that's a positive, especially this holiday season, for people who want to avoid crowds. And also a really big risk for department stores that are mall-based and mall-based retailers as a whole is that malls will reclose if COVID-19 resurges out proportionally this holiday season. From a financial perspective, Kohl's is also better positioned as well.
Okay, great. And here's one for Tuna. Tuna, what impact might the COVID-19 pandemic have on U.S. e-commerce growth and Amazon's share?
Sure. I would say that COVID-19 has significantly accelerated a secular e-commerce growth in the U.S. by several years. I mean, you could pick a number anywhere from 2 to 4 years. I would say, just based on the trends that we've seen the past few quarters. And with that being said, I would think that Amazon Amazon's market positioning has even gotten better, thanks in large part to the investments in logistics and infrastructure and shipping and one-day delivery. If you remember the chart that we looked at. So all of those investments, we would argue, has positioned Amazon to continue to build on its dominance and just continue to ride this COVID-19 demand tailwinds. And the question is, how much of that consumer behavior is going to be sustained when post-vaccine? And from all indications, it just seems like consumers, a fair amount of that behavior can be expected to last even beyond the COVID-19. So it remains to be seen, but the acceleration has been quite remarkable, and we would expect the inflection point for Amazon's share to turn, to approach 1/3, perhaps in the next 4 to 5 years, if these trends continue.
Okay, back over to Camilla. What are some retailers you would recommend as COVID-19 recovery plays?
We like TJX, which reported this morning, also Ross and Ulta. All three of these companies are high quality. Their earnings just have been hit specifically in the second quarter because of the lockdowns and also social distancing guidelines. But long term, we don't see their earnings power impaired. All of these players are very well positioned to capture market share, specifically TJX and Ross from department stores, and then Ulta from department store makeup counters, and then also as Sephora shrinks its footprint.
Okay, here's one for me. What services do you think Walmart will add to Walmart Plus over time? That's a good question. Walmart really isn't showing their hand, and there's been a lot of speculation on that, but they just really haven't said. There's been some talk that they could add streaming video like Amazon had, streaming video and music, but they actually had a business called Voodoo that they sold to Fandango earlier this year. And so they seem to be getting out of that business, not growing it, but that could change. They've shown an interest in getting into pharmacy and in healthcare. That's something you saw with Amazon's announcement yesterday. Basically, these retailers are trying to all become one-stop shops for a lot of different services and really grow their customer loyalty. They want to all be like the retailer, the provider of services. But I think Walmart will increasingly leverage Sam's Clubs, which is the top competitor to Costco, especially providing delivery of the bulk items that are so popular at the warehouse clubs. If they can offer home delivery of some of those large bulk items, that really gives them an edge over the competition. And I think they'll also probably introduce tiered subscriptions in the future, like Costco has with their Gold Star and then the business membership. I could see them. Right now, they just have the Walmart Plus, $98 a year, but I could see them offering a Premier membership, perhaps with a 2-hour delivery option instead of same day. That is a little bit more expensive than Walmart Plus. So, those are the things I would look for them to roll out over the next few quarters or so. And then, so I think that takes us, it's 12:05 now. Apologize for going a bit over. One thing I wanted to mention, last but not least, we have another webinar coming up in less than 2 weeks. That's on Tuesday, December 1st. We'll have the future of the industrial sector, infrastructure, and the global forces driving change. And registration is now open for that webinar via the link below or on MarketScope Advisor. Thank you very much for your interest today, and we hope you found this webinar very informative. Appreciate it. Thank you, and have a great rest of the week.